Gold prices have been surging to new heights recently. As global uncertainty intensifies, investors are flocking to gold as a safe haven, driving its value even higher. This gold rush has sparked fears of a potential gold shortage, further fueling the price rally. But is the world really running out of gold? Do central banks actually hold the reserves they claim, or is it all just paper trading? My name's Guy, and today I'll break down what's really happening in the gold market and where it could be headed next. Stay tuned. Now, if you've been following gold's recent price action, you'll know it's been on a parabolic run lately. As I record this, gold is trading at an all-time high and is quickly approaching $3,000 per troy ounce. In fact, gold has outperformed stocks over the last year, surging by 45%. So then, what's been driving this impressive rally? Well, there are a number of factors, and perhaps the most obvious is speculation. As investors catch on to gold's performance, many more have piled in, hoping to ride the wave and capture some of those gains for themselves. But good old-fashioned FOMO isn't the primary force behind gold's rally, not by a long shot. The real story lies in a growing number of investors turning to gold as a hedge against a range of mounting risks. For example, many investors are turning to gold as a safeguard against unsustainable fiscal policies and the debts that pile up as a result. Spending by governments and printing by central banks has caused inflation, which continues to be a huge concern and has further driven the demand for gold. Geopolitical tensions are also playing a major role. From the ongoing conflict in the Middle East to the war in Ukraine and the rising trade tensions between the US and several other global powers, uncertainty is everywhere. And as tensions rise, assets like gold become much more attractive for citizens and sovereigns. Now, one of the biggest buyers in this sense has been Asia, particularly China, which has been scooping up gold by the bucket load. The People's Bank of China, or PBOC, has been aggressively boosting its reserves, aiming to reduce its reliance on the US dollar. Following a 6-month pause, the PBOC began buying gold again in November, accumulating around 44 tons of the stuff throughout 2024. This brings China's 2024 gold total to around 2,280 tons. And China isn't alone. Countries like India, Turkey, and Poland have also been ramping up their gold reserves. India accumulated 72 tons of gold in 2024, bringing its total to 876 tons by the end of the year. Turkey accumulated 75 tons to bring its total to 614 tons of gold, and Poland scooped up 90 tons of the yellow stuff to bring its 2024 total to 448 tons. In fact, central banks around the world collectively added over 1,000 tons of gold to their holdings throughout 2024, marking one of the largest accumulation sprees in recent history. Central banks have in fact been net buyers of gold for the past 15 years though. And according to the World Gold Council, this trend is unlikely to slow down anytime soon, as central banks are expected to remain a primary driver of the gold market in 2025. Some reports suggest that almost 70% of central banks around the world plan to increase their gold reserves. At the same time, Chinese investors have turned to gold to preserve their wealth, given the weakness in the housing market. Oh, and by the way, if you're digging this golden content, smash that like button to give it a boost, subscribe for more treasure, and ping that notification bell so you don't miss a nugget of new info. Now, this talk of central banks brings us to the primary reason why gold has been in the headlines lately, and that's the recent gold rush that's been fueled by investors desperate to get their gold moved from certain countries, namely the UK, to the United States as quickly as possible. For context, the UK's central bank, the Bank of England, is the world's second largest custodian of gold behind China. To be exact, there are 9 underground vaults in London holding approximately 8,500 tons of gold, worth around $771 billion. Crazy stuff. However, in the last few months, the amount of gold being stored in London's vaults has been falling. That's because many investors are worried that US President Donald Trump will implement tariffs on gold as part of his wider tariff regime, and They're desperately trying to get their gold moved to gold hubs in the US, like New York, before it's too late. At the time of shooting, Trump hasn't officially announced any tariffs on precious metals like gold or silver. But he has implemented 25% tariffs on other metals, namely steel and aluminium, or if you use Fahrenheit, aluminum. Anyway, this has caused panic that other metals will be targeted, with gold being at the forefront of everyone's mind. As such, around 8,000 bars have been moved from London to New York in the last few months alone, roughly 2% of London's total. Now, that may not sound like much, but remember, we're talking billions of dollars worth of gold here. Among the biggest names flying gold across the Atlantic are HSBC and JP Morgan. Why? Well, to cover their losses on short positions. You see, normally, physical gold owned by banks is stored in vaults like the ones in London, and that gold is then lent out for a profit. The bank then protects itself against any price drops by selling gold futures contracts on New York's commodity exchange, or COMEX. Now, this setup is usually low risk, since the spot price of gold is usually very close to the futures price on New York's COMEX. If gold prices fall, physical gold loses value, but futures contracts gain value, so it balances out. Conversely, if gold's price rises, physical gold becomes more valuable, but the price of futures contracts falls. This balance is how banks hedge against price fluctuations and why banks are constantly shorting gold. It's functional rather than nefarious. However, because of the political uncertainty in the United States, particularly after Trump's election victory in November, many investors went long gold. As such, gold futures prices on COMEX shot up much higher than the spot prices in London, effectively breaking the hedging strategy. This disconnect has created an arbitrage opportunity for investors with gold stored in London, since they can get it moved to New York to be sold at a higher price. So, for many investors, this is great news. But this isn't such great news for banks. That's because all of a sudden the contracts they were using as a hedge were worth a lot more, meaning banks were losing money on them. So they were faced with two options. Either deliver gold against these contracts fast, or sell those contracts at a loss.
Hello, it's me, Guy's cousin Barry. I'm very sorry to be interrupting this no doubt fascinating video, but I want to tell you about the Coin Bureau deals page, so listen up and listen well. Alright, this is the place where you will find all the amazing promos and discounts what you, as Coin Bureau viewers, are entitled to. So don't be a mug, go and check it out using the link below. You'll find discounts on hardware wallets, you'll find exchange sign-up bonuses, some of which are absolutely bleeding mental, and you will find trading fee discounts there as well as a whole load of other goodies too. And let me tell you, old Barrington here, he's had to hammer the dog and bone all bleeding day and night to get you these promos and discounts. So you're welcome, thank you very much, go and have a look pronto, or I'll have to come and have a word. Alright?
Now, it goes without saying that no bank wants to lose money, which is why moving gold quickly has become a top priority. The problem is that it's far easier said than done. Moving billions of dollars worth of gold bars is a massive undertaking, quite literally. Not only is this gold extremely heavy, but it also requires extensive physical resources, tight security, and, most crucially, time. Put simply, bank vaults just aren't designed for sudden, large-scale gold movements. This has resulted in a whole bunch of logistical problems that have created a bottleneck for banks and investors hoping to get their gold moved ASAP. The problem with these delays is that it means that banks are then stuck with losing trades. And this is a bigger deal than you might think. If a bank makes huge losses, even on paper, they would need to set aside more capital as a safety net, rather than use that capital for investments. This opportunity cost could limit the bank's ability to operate profitably for years. Put simply, they can't afford to wait. In fact, Bank of England employees have reportedly been inundated with calls from banks trying to fast-track their gold transfers. However, everyone is being told the same thing: wait your turn. The thing is, this obvious desperation has only driven gold prices higher, triggering a feedback loop. As prices rise, more banks scramble to move their gold, further clogging the system. The thing is, these delays have fueled concerns about a shortage of gold supply, and although this isn't entirely accurate, there is a shortage when it comes to gold's liquidity. And this is where things get a little technical, so listen carefully. According to the London Bullion Market Association, or LBMA, there were around 279 million ounces of gold stored in London's vaults as of December 2024. At the same time, the volume of gold being traded through spot and cash contracts was estimated to be around 380 million ounces. Now, to be clear, this isn't the amount of physical gold sitting in vaults, but rather the total size of paper contracts representing gold obligations in the market. However, only about 36 million ounces of that stored gold was actively available to be bought or sold. This is called the float, referring to gold that is not already tied up in long-term holdings, central bank reserves, or other commitments. This means that this gold float represents roughly 10% of paper trading volume, which is a major liquidity shortfall. That's because there's literally 10x more gold being traded on paper than there is physical gold readily available for delivery. As a result, when banks demand physical delivery, there are severe delays because that gold simply isn't available. These delays can effectively amount to a technical default as banks and other institutions fail to meet delivery obligations on time. So, as you can see, this mismatch between paper gold and physical supply can get very messy very quickly. Now, while there's very clearly a liquidity shortfall in the gold market, it's important to note that there is technically enough gold to go around. However, while there's no immediate gold shortage, that's not to say there won't be one in the not-too-distant future. 2025 is set to be a pivotal year for the gold industry. That's because gold production is forecast to fall as the ore grades, that is, the concentration of gold within an ore, continue to decline and aging gold mines are closed down. What's more is that some of these mining companies are considering closing down for good. That's simply because mining companies are facing significant cost increases, including labour and regulatory expenses. What this means is that despite gold's price being more profitable than ever, many miners could be forced out of business. Some analysts predict that this would cause gold production to fall by around 17% by 2030. This marks a turning point for the gold market, which is seeing an ever-growing demand due to things like fiscal policy changes and geopolitical tensions. When you combine these factors with the depleting reserves of gold as investors scramble to buy more, you quickly see that a supply shortage could very well be on the horizon. Obviously, this would push up gold's price. But while a surge in gold's price may benefit investors, it could spell trouble for several industries. For instance, tech companies use gold for its superior conductive properties, making it a key component in electronics like smartphones and computers. This is also why green energy companies use gold in many of their products, such as solar panels. Gold is also very biocompatible, making it a choice material for medical implants and diagnostic tools. It's even used in space, since its resistance to corrosion makes it durable enough for satellite components. Now, obviously, these are just a few examples where gold is more than a luxury or an investment. The point is, as gold becomes more scarce and expensive, costs will rise across these sectors, squeezing businesses and ultimately driving up prices for consumers. Some companies may struggle to survive, while others will pass their skyrocketing manufacturing costs onto the public. So then, by now we understand that gold's liquidity is being squeezed, and while there's no immediate gold shortage, this is a real possibility in the future. So this begs the question of how all this could affect gold's price. Well, in case it wasn't obvious, gold's price is set to keep rising. The question is, by how much? This is exactly what many market analysts have been trying to determine, and what's intriguing is that many have recently adjusted their forecasts, and they're surprisingly consistent. For instance, UBS strategist Jovi Tevez predicts that gold will hit a peak of around $3,200 per ounce in 2025. Notably, this is $100 more than another UBS forecast made just 3 weeks beforehand. It's a similar story with Goldman Sachs, where analysts say that, quote, if uncertainty regarding economic policy continues, including tariffs imposed by the United States, speculative gold demand may increase alongside rising gold purchases by central banks and inflows into exchange-traded funds. Similar to UBS, Goldman Sachs analysts raised their forecast to $3,100 per ounce, a $100 increase from a forecast made just 1 month prior. Meanwhile, Michael Widmer, an analyst from Bank of America, predicts that gold could reach as high as $3,500 per ounce, assuming that retail and institutional demand jumps by 10%. Michael says that this is a lot, but it's not impossible. We reckon it's actually quite likely, given the current state of the gold market. On the lower end, meanwhile, Citigroup forecast a price range of $2,800 to $3,000 per ounce. Meanwhile, UK bank HSBC predicts that gold's 2025 price will be within a range of $2,350 and $2,950 per ounce. Elsewhere, ANZ Research predicts gold's price will be around $2,805 per ounce, and Commerzbank forecasts that gold's price will fall to as low as $2,600 per ounce. However, some analysts are slightly less bullish, giving out forecasts lower than gold's price at the time of shooting this video. This suggests that gold's price could be hitting a local top. Overall, then, it's a bit of a mixed bag. However, from our perspective, the view that gold may be approaching a local top appears to hold the most weight, no pun intended. That's simply because much of gold's price action seems to be driven by uncertainty and the surge in investors rushing to move gold into the US ahead of potential tariffs. Logically then, if Trump were to confirm that there will be no gold tariffs, this uncertainty would end and the flow of gold into the US would slow down significantly. The same would be true if we see a lasting resolution to conflicts in places like Ukraine, which would reduce geopolitical uncertainty and thus gold demand. If gold's price is indeed approaching a local top, then this raises the question of how this could affect alternative assets, namely silver, the precious metal alternative to gold, or Bitcoin's BTC, which is widely considered to be gold's digital alternative. Silver is likely to perform well for multiple reasons. Generally speaking, silver's price tends to follow the price of gold, but with higher volatility. So, as gold's price rallies, the price of silver will rally even harder. A widely watched indicator for assessing silver's performance is the gold-to-silver ratio. Simply put, this ratio represents how many ounces of silver are needed to buy 1 ounce of gold. When the ratio is elevated, indicating gold is expensive relative to silver, it often suggests that investors may shift from gold into silver in search of better value. An golden rule used by many investors is something called the 80-50 rule. Basically, if the gold-to-silver ratio is above 80-1, meaning you can buy 80 ounces of silver for 1 ounce of gold, silver is undervalued. It's time to switch to silver. If the ratio is below 50-1, silver is overvalued and it's time to switch to gold. At the time of shooting, the ratio is sitting at around 89-1. This suggests that gold investors are due to rotate into silver at any given moment. This is incredibly bullish for silver's price, which is already approaching its previous all-time high set way back in 2011. A breakout beyond that level would propel silver into price discovery mode, with the potential for significant upside. Alternatively, some gold investors could rotate into BTC, which is considered by many to be digital gold. This could make BTC a top choice for gold enthusiasts struggling to get their hands on physical gold. It also helps that BTC happens to be the highest performing asset of all time. Just saying. Just like gold, BTC is seen as a store of value, offering similar benefits to gold as a hedge against inflation and economic instability. But the thing that separates BTC from gold is BTC's convenience. That's because, unlike physical gold, which is proving to be impractical at times like this, BTC doesn't require physical storage and can be sent to anyone around the world in mere minutes. Come to think of it, the recent squeeze of available gold is concrete proof of why BTC is the superior asset. But of course, gold investors have another form of digital gold, and that's gold-backed stablecoins such as Paxos's PaxG or Tether's XAUT. In the eyes of some of these investors, these will serve more of a digital gold role than even Bitcoin. They're literally tokenized versions of gold itself. And best of all, it'll be much easier for these investors to simply convert those tokens into other cryptos, such as BTC. Not to mention that they'll be able to store it all on a discounted hardware wallet from the Coin Bureau deals page. Link below. Okay, if you liked that video, then don't forget to check out our latest one here. And if you're not subscribed yet, you can do that here. That's me for now. Thank you all so much for watching, and I will see you next time.